Everyone, and welcome back to The Explainer. Today we are unpacking a truly fascinating contradiction in the market right now. We're looking at Atmus Filtration Technologies. You'll see them trading under the ticker symbol ATMU. And guys, we are looking at a massive paradox today. On one hand, this company is out there posting absolute record-breaking sales and executing their business model pretty much perfectly. But on the other hand, it is trading at this massive premium that is literally setting off alarm bells across multiple classic valuation models. Now, just a quick reminder right out of the gate, just to make sure we follow YouTube guidelines perfectly, this explainer is strictly an educational breakdown of the financial data and analysis. We're covering all the points objectively, so this is definitely not financial advice.
So let's dive right into this with the big core question we really need to answer today. Is ATMU building a genuine economic moat that actually justifies this premium price tag? Or is it a classic valuation trap just waiting to spring on unsuspecting investors? Keep that question rolling around in the back of your mind as we go through the data today, because I gotta tell you, the answer we arrive at by the end of this explainer might seriously surprise you.
To really wrap our heads around the sheer scale we're dealing with here, just take a look at this number, $528 million. That is AMU's record second quarter revenue. That's up 16.4% year over year. This immediately tells us that we aren't talking about some tiny speculative startup trying to find its footing. No way. This is a massive operation with serious flowing cash and some truly undeniable momentum. But before we get completely lost in the financial weeds, let's just ground ourselves for a second and establish exactly what this company actually does. Atmus Filtration Technologies manufactures filtration products for commercial vehicles and off-highway equipment. You probably know them best by their flagship brand, FleetGuard. Fun fact, they were actually spun off from the industrial giant Cummins pretty recently, back in 2023. So they have this massive, established legacy footprint, but they are still relatively new as their own standalone public entity.
All right. Let's get into Act 1, the bull case, or what we'll call the green flags.
We always want to start by looking at what a company is doing right. And honestly, the operational story here is just glowing. The financial wins are totally undeniable. Like we just talked about, that record Q2 revenue of $528 million, that actually beat consensus estimates by over $20 million. And their bottom line efficiency is looking super clear too. Q2 non-GAAP earnings per share came in at 82 cents, which beat expectations by 4 cents, and they generated a really strong $67 million in free cash flow. Because of all this incredible momentum, management actually went ahead and raised their 2026 sales guidance, and they're now projecting between $1.975 and $2.03 billion. Basically, the company is just hitting every single one of its operational targets right now.
But you know what? Those operational beats are really only half of the bull case. The structural strength of the business itself is where things get really compelling. Get this, 86% of their revenue comes from the aftermarket. That is absolutely crucial because it creates highly durable, recurring demand and serious customer lock-in. And they've protected that lock-in with roughly 1,200 patents. All of this high-quality execution earns them a solid guru-focused score of 81 out of 100. And unsurprisingly, Wall Street absolutely loves this story. The analyst consensus right now is an overwhelming buy with an average price target of $66, which implies nearly a 29% upside from where it's sitting today. And the best part, they are doing all of this with a super safe balance sheet. Their net debt to EBITDA is just 1.9 times.
So that brings us to Act 2, the bear case, and those inevitable red flags. Now, if we just stopped the explainer right there, you'd probably be rushing out to buy shares, right? But hold on a second. Underneath that seemingly flawless operational surface is a pretty harsh reality check that the broader market seems to be totally ignoring right now. Let's look at some of these valuation warnings. The Guru Focus value for AMTU is calculated at just $42.13. With the stock currently trading around $54.50, that implies it is nearly 29.4% overvalued. Plus, the trailing price-to-earnings ratio is sitting up at 21.38. That is notably higher than the company's own 5-year median PE, which is closer to 16.9. So while that quality score we saw earlier was great, the valuation rank is a pretty dismal 5 out of 10. The market is basically pricing an absolute perfection here, banking on above-average growth that honestly just might not be sustainable.
And if you want to know what the people actually running the company think about that premium valuation, well, just look at this. Over the last 3 months, insider selling has outpaced buying by a staggering 16-to-1 ratio. We are looking at $1.6 million in insider sales versus a microscopic $100,000 in purchases. And we're not just talking about random employees cashing out a few shares. The senior vice president of Power Solutions personally dumped over $721,000 worth of shares at $64.53.
Listen, when the executives are selling heavily into a rally, that is a glaring red flag that you simply cannot ignore.
But hey, if you thought that GF value was conservative, brace yourself for this number, $13.75. That is ATMU's gram number. If you're not familiar, that's a highly conservative calculation of a stock's intrinsic value based on Benjamin Graham's classic defensive principles. With the stock trading around $54, it is currently trading at roughly 3 to 4 times its gram number fair value. A 73% downside to Graham's absolute floor is, quite frankly, a massive reality check.
And it's not just the price tag we have to worry about. There are real growth and macroeconomic risks brewing here too. The Peter Lynch Fit engine actually gives ATMU a failing grade of 59 out of 100. Why? Mostly because the PEG ratio, which measures a stock's price relative to its earnings growth, is highly stretched at 3.87. Lynch always wanted to see that number under 1.0. Furthermore, despite that record Q2 they had, actual aftermarket conditions are remaining flat year over year right now. That's mostly due to subdued global demand outside of China. Add in moderating pricing and higher commodity costs, and management is actually expecting their second half margins to soften. The bottom line? The growth simply isn't keeping up with that premium price tag.
Which brings us to Act 3, the Guru Test, where we look at the objective analysis.
Okay, we've seen the green flags and we've seen the red flags. Now it's time for the ultimate objective test. To make sure we cover all the points today, let's run ATMU through the most legendary investing frameworks in history to get a systematic consensus. First up, the moat framework gives it a 5 out of 10. It definitely has a genuine narrow moat thanks to that 86% aftermarket lock-in, but it lacks the severe pricing power you really need for a wide moat. Next, Benjamin Graham's framework gives it a mixed 77 out of 100. It absolutely loves the strong balance sheet, but it completely rejects the high PE, the high price-to-book ratio, and of course that 1375 gram number we talked about. Then we look at Peter Lynch. That's a hard fail. A PEG of 3.87 and EPS growth of just 5.4% means the growth is just way too low to justify the current price. And finally, Warren Buffett's framework. Another hard fail. The gross margin of roughly 28.8% is far below his 40% target, and the 5-year average return on invested capital is a tiny 0.2%, which suggests those recent returns might just be cyclical. Look at the board. Every single legendary framework here either totally rejects or heavily questions this valuation.
All right, let's wrap this all up with the final verdict. Risk versus reward.
Remember, the whole goal of this explainer is to just observe and distill the data for you objectively. We are definitely not sitting here telling you to go short the stock or panic sell your shares. The core thesis here really boils down to a classic battle between quality and price. The bull case is absolutely spot on about the high-quality operational story. AMTU is out there executing brilliantly in a highly profitable niche market, and they have real tangible competitive advantages. But on the flip side, the bear case is equally right about the extreme valuation premium. The stock is currently priced for absolute perfection, which leaves basically zero margin of safety for the investor if global demand softens even just a little bit.
It perfectly brings to mind that classic quote from the Oracle of Omaha himself, Warren Buffett, "Price is what you pay, value is what you get." When you're looking at roughly $54 a share, you are paying a significant, undeniable premium for the actual value you are getting in Atmus Filtration technologies today.
Which leaves us with one final question for you to chew on. Will you add ATMU to your watch list and exercise a little patience? Look, the operational quality definitely makes it a company worth keeping an eye on, for sure. But the data strongly suggests that waiting for a significant pullback, ideally dropping much closer to that $42 intrinsic value mark we saw earlier, is the way to go before committing any of your hard-earned capital. Thank you so much for joining me for this explainer. Keep learning, keep analyzing, and I'll see you on the next one.